All right. It is 10 a.m. It is July 9th. We are doing the monthly Make Taxes Fair open office hour webinar. I'm going to let people filter in and we'll get started here in just a moment. There's been some roller coaster stuff. July 4th, the big, beautiful bill, or what they call Uh, some people are calling it OB3. I kind of like that because I'm a Star Wars person, so it sounds like a R2D2 CP3O. I don't know. So OB3, one big beautiful bill, it has been signed into law, and so today we're going to go into that tax law changes. I'm going to share my screen and let's take it away. Right. Everybody there, can you see my screen? I'm seeing yes. Cool. All right. And let me just make this available so I can see questions, comments. Okay. All right. So today's presentation is the One Big Beautiful Bill, or OB3 recap, presented by me, Chris Middleton at Make Taxes Fair. To give credit where credit's due, this presentation material was originally created by Mr. Edward A. Lyon, a tax attorney who I follow, respect, and love. Great guy. And he called his presentation the One Big Beautiful Tax Summary. So I have taken his presentation and modified it, added my own kind of narrative to this. So let's take it away and go from there. So let's rewind here to 2017 because in 2017 Congress passed what was called the Tax Cuts and Job Act, or TCJA. And that was a massive shakeup to the US tax code. It was probably one of the biggest rewrites in over 30 years of tax law. And it was promised to simplify taxes and spark, economic growth. At least that's how it was pitched. Back then, it was passed without a single vote from the Democrats. Republicans, who held control of both sides of the House, the chambers at the time, they pushed it through using a special tool called budget reconciliation. So this is all kind of background and foundation of what the OB3 is. Um, so why did they push that through with the budget reconciliation? Well, it bypassed the usual 60 vote hurdle in the Senate, which is a simple majority, it just gave them the simple majority, no filibuster. But here's the catch: when reconciliation rules are used to change any taxes that increase the federal deficit beyond 10 years, there has to be what's called a sunset clause. And so that's tax terminology for it expires, right? So they were not permanent laws. They had a sunset or expiration date. So most of the individual tax cuts for everyday Americans were set to disappear on December 31st of 2025 unless the laws changed, right? So back in 2017, that felt like a lifetime ago or away, but here we are now, and that clock is ticking, getting to the December 31st, right, of 2025. The Urban Brookings Tax Policy Center uh, projects that if the tax laws had sunset, 70% of America would pay more in taxes as a result. So that would be a huge hit to small business owners, families, and working professionals, right? People that really can't afford to play guessing games. You and I, that can't afford to play guessing games with our money and our tax bill. Congressman Jason Smith, chair of the House and Ways and Means Committee, he put it bluntly, this is the Super Bowl of taxes, right? So these expiring provisions were really critical in the views of a lot of politicians and in a lot of Americans' eyes. So what happened next, right? Republicans went on to make key parts of the Tax Cuts and Job Act from 2017 permanent, but they also wanted to raise the debt ceiling, boost military and border spending, and keep a lid on the national debt. So um, Trump, went into and said, this has got to be bundling it all into a must pass package, and he called it the big beautiful one big beautiful bill. That's where the term came from. So on May 25th, House Republicans unleashed a 976-page draft of the bill, and what followed over the next 6 weeks was, the negotiation process, rewrites, and political chess moves, right? And it barely squeaked through, but it did pass both sides of Congress and was signed into law on July 4th. And so that means it's law. So let's bring it home to today, right? So today we're going to walk through what this means for you, and we're focusing today on the individual taxpayer and entrepreneur, the corporate tax changes and Medicaid provisions. We're not going to, those don't hit a 1040. So we're not talking about those today. We will at some point. And I just got to say, I'm not here to say red versus blue, Republican versus Democrat. Just giving you context and giving you the facts and the impacts and some strategies to stay ahead of the game, right? Because when it comes down to it, knowledge, understanding, and having a foundation is how, with the starting point for uh, paying less in taxes. So I ask you today to apply the FIRE method. We're going to ask you to focus in, listen up, pay attention. We're going to go through and we're going to talk a little bit. I want to help you understand the impact of these things. And then once we focus and understand the impact, now we can revisit or react and say, hey, what do we need to do? And that's how we get to efficiency. So, again, focusing today on the individual taxpayer and the entrepreneur, the corporate tax rates, C Corps, and the Medicaid provisions, those aren't going to hit your 1040, so we're not going to address those necessarily today, right? So let's get into it. So, what did the 2017 Tax Cuts and Job Acts really change for individuals? Well, break it down into 7 key areas that directly impact everyday taxpayers and business owners. So, 2017, which is really the OB3, or the one big beautiful bill, is extended and leveraged off of the 2017. That's why we're bringing that up again. So, lower tax rates, right? That was the first thing. Across the board, most personal tax brackets dropped, which meant lower tax bills for many people, at least on the temporary basis. Um, the standard deduction effectively doubled. And so instead of itemizing, and we've seen this over the last few years, many more people are now taking the standard deduction, because that effective doubling of the tax of the standard deduction allowed more people to take the standard deduction over itemized deductions. But here's the trade-off: personal exemptions disappeared, right? And so there was some impact there that hit large families or some joint tax filers, right? The child tax credit was boosted. The child tax credit increased for the first time in a long time. It became more accessible during the pandemic. It even temporarily expanded further. That has since rolled back and is no longer there. But still, that's a very valuable credit for families that have children, and many people rely on that to help them on their taxes. There's a new qualified business income deduction. That changed. That had been introduced, and was really the Section 199A, was brand new. And that was a game changer for a lot of small business owners that were not C corporations. Congress didn't want Main Street business owners like S Corp, LLC, sole proprietors to get left behind when the corporate tax rates dropped. So they introduced the QBI deduction, that Section 199, letting many pass-through entities deduct up to 20% of their income. That was a large boon. Accelerated depreciation, business owners got to faster ways to deduct the cost of equipment. Think of computers, machinery, even certain vehicles. And so accelerating the depreciation allowed entrepreneurs to write off large amounts in year one, instead of spreading it over time. I'll be honest with you, depreciation and accelerated depreciation, or bonus depreciation, is not one of my favorite strategies, because you're robbing the future of deductions, right? You're deducting it now, which is great, but you're stealing deductions from the future. So I like that when we need to use it, we do, or when we can use it, we do. But at the end of the day, I prefer other tax strategies over the accelerated depreciation. So I'm going to get rid of that notification there. All right. There was a $10,000 SALT cap. Well, before the Tax Cuts and Job Act, there was no limit on what you could deduct in the state and local taxes. But in 2017, that got capped, right, at 10 grand. And so that hit hardest the high income tax states or high tax states like California, New York, and New Jersey. The estate tax exemption doubled, right? And so the threshold for federal estate tax really jumped, meaning fewer families had to worry about a death tax. But like many of the individual provisions, that higher exemption was set to expire at the end of 2025. Let me briefly address corporations. So the Tax Cuts and Job Act did flatten the corporate tax rate it dropped it down to 21%, replacing it was a flat 21%, which replaced the graduated system previously that peaked at 35%. It also eliminated the corporate AMT or alternative minimum tax and really rewired how international companies get taxed on foreign income. But there's a twist to that because unlike the individual tax breaks, corporate tax changes were made permanent, right? Permanent meaning there was no sunset provision or no expiration date, or so they say. So, at the end of the day, let's be real. Washington, D.C., the Congress critters, they do what they want. So permanent, they can change the laws, make it unpermanent by changing laws or passing new legislation that replaces old legislation. So that's kind of where we are today. The Tax Cuts and Job Act delivered real savings to many Americans and business owners, but with those sunset dates of December 31st, 2025, there was a onus on Congress to say, hey, and the president to say, hey, are we going to do something about this or are we going to let them expire? And so the more proactive you are in kind of learning about these and saying, okay, what changed or what didn't change and how does that affect me is going to impact your ability to manage your finances. So let's talk about the biggest headline across the board that was from the 2017 Tax Cuts and Job Act that is relevant today, lower tax rates across the board. So most immediately noticeable was a change, was a broad cut to individual rates. And so except for the lowest 10% bracket, every other bracket dropped, right? The 15% dropped to 12%, the 25 to 22, 28 to 24, and then higher brackets you can read. I'm not going to read that to you. Saw similar cuts. So that meant across the board more take-home pay for millions of Americans because they were being taxed at a broadly lower rate. Business owners using flow-through entities like S corps or LLCs, these cuts help to reduce the personal taxes owed on your business income. So fast forward to today from 2017, and here's the good news. The big beautiful bill or OB3 makes those cuts permanent. So that means there's no expiration dates to these tax brackets. There's no sunset clauses, just they're locked in as the tax rates for now until somebody changes that, right? And there's always that trade-off. So according to the Nonpartisan Congressional Budget Office, or CBO, making these tax cuts permanent could add about 2.2 trillion to the national deficit over the next 10 years. So while that's a win for us today, that could mean more pressure on future tax policy. Congress and the politicians saying, "Hey, we need to raise taxes." So the bottom line is cuts now help us with historically low rates, but don't bank on those to be long term, right? You want to build smart in the every year that you're working in your taxes. Another area that was a big move from the 2017 Tax Cuts and Job Act was the standard deduction nearly doubled. So for single filers, it jumped from 6,350 to 12 grand. For married filing joint, it went from 12,700 to 24,000. So very large jumps, big change. And that instantly, a lot of people that were not already itemizing saw some immediate relief. But Congress, the Congress critters, like I say, they never give without taking. So in exchange for those bigger deductions, they eliminated the personal exemptions, which were $4,050 for each filer, spouse, and dependent. They lowered the mortgage interest rate cap. So if 1 million in debt to 750,000 in debt, they capped the state and local or SALT deduction at that 10 grand. And then they scraped away miscellaneous itemized deductions category completely. So if you were a employee working for somebody and you had unreimbursed employee expenses, you were no longer able to deduct those. So I encountered several types of clients that impacted pretty heavily. But overall, we saw, quite a jump in benefit to most people. The immediate impact of all that was about 30% of taxpayers used to itemize. After the Tax Cuts and Job Act, that number dropped to 10%, around 10%. And so the higher standard deduction was really helpful for most people. But again, the larger families, especially those who had claimed several personal exemptions, sometimes saw a higher tax bill under those new rules. So fast forward to today with the One Big Beautiful Bill, or OB3, it not only makes these higher standard deductions permanent, it even increases them again for a few years. So in 2025, the standard deduction will rise to 15,750 for single filers, 23,625 for head of household, 31,500 for joint filers, and scheduled to increase each year. So what does that mean for you, right? Um, well, the CBO, again, the Congressional Budget Office, say this bump in the deductions, right? If we increase deductions, that decreases taxable income. So they're saying that will add about 1.4 trillion to the deficit over the next decade. So most families will benefit. A few itemizer people that are currently itemizing mean they could have a simpler filing, and higher deductions means more income is protected from tax. But again, if you're in a high income tax state, carry a big mortgage, it could evaluate, you'd be smart to say, okay, do we still need to itemize? Um, and for business owners, knowing whether you should itemize leveraging your deductions through an accountable plan or fringe benefits, that matters even more, right? If you're not able to deduct certain things on your personal tax return, is there a way to capture them on your corporate? It's also notable to say, hey, there's a lot of states that do not comply, or yeah, there's a non-conforming policy to where a state may say, hey, that's cool that the federal is this, but even though you don't itemize for federal, you still may itemize for the state level, right? So it's important to understand that distinction and that there could be a difference between your federal and state if you live in a state where there are income taxes. One of the more family-friendly pieces of the 2017 Tax Cuts and Job Act was the child tax credit. It got a really kind of that major upgrade, and for many households, this was one of the biggest money-changing savings of the whole bill. And so what 2017 Tax Cuts and Job Act did was it doubled the child tax credit from 1,000 to 2,000 per child. So it made up to 1,400 of that refundable. So even if you owe zero taxes, you could still get a refund check. And then it raised the income limit so that more families would qualify. So before, there was a phase out starting at 75,000 if you're single, and the phase out after started at 200,000. So it was 110,000 joint if you're married filing joint, and then it bumped to 400,000 for married filing joint. So significantly more families were able to claim the child tax credit before the phase out started to kick in. It also added a $500 non-refundable credit for older children, 17 and older, elderly parents, or other qualifying relatives. So, and it's important to understand, and we won't get into the weeds on this one, but the child tax credit is actually comprised of two components, the child tax credit and the additional child tax credit. Child tax credit is non-refundable, and the additional child tax credit is refundable. So that's where that refundable credit could help. If you wiped your tax bill down to zero and still had credit left, you could get a check back in the mail or direct deposit, right? So the Tax Cuts and Job Act started the process, but then in 2021, the story of the child tax credit doesn't stop there. 2021, the American Rescue Plan, post-COVID or during COVID, temporarily beefed up the child tax credit. So it bumped it up to $3,600 per child from ages, newborn to 6 years old, and then up to $3,000 for children 7 to 17, and 100% of it was refundable. So that really gave a lot of Americans that were claiming children on their taxes a pretty substantial bump. So that expansion really cut the child poverty in half, according to several studies. And in 2024, the House tried to bring some of that back, but the Senate didn't pass it. So um, at the time, Senator J.D. Vance even proposed a flat $5,000 credit per child. That didn't move forward either, but either way, the child tax credit's been on everybody's radar since 2017, messing around with the child tax credit. So fast forward to today with the One Big Beautiful Bill, or OB3, made these key changes. So it permanently, instead of temporarily, it permanently doubled the credit from the 1,000 to the 2,000, because remember that was set to drop back as of December 31st, 2025. So affecting 2026 tax returns, it was effectively going to drop back to the $1,000 mark from the 2,000. And the OB3 temporarily increases the child tax credit to $2,500 instead of 2,000, and that's from 2025 through 2028. It also indexes the credit for inflation starting in 2026, which, to my knowledge, we've never seen. So that means that the credit will get, like the standard deduction gets a inflation bump every year, the credit will also start to receive a credit for inflation. That's a good thing, in my opinion. The credit permanently locks in the $500 credit for non-child dependents. And at the end of the day, the CBO estimates these updates will cost about $817 billion over the next 10 years. Again, I bring that up in those notes because they're relevant to future potential law changes, because these are now permanent tax laws, meaning there's no expiration date. There's going to be no provision of that expiring or sunsetting. But in the future, that's going to be the argument of the politicians, is like, oh, this is creating a deficit. We need to eliminate or take away these credits or put caps on them. So you got to be mindful of the greedy politicians and what they're looking at. So the credit isn't just a line item on most people's tax return. It's real money potentially back in your pocket, right? Reduces your tax bill, creates a refundable credit. So for many families, especially with the rising cost of food and cost of living, that can give more breathing room. For business owners, it could be part of your overall strategy to lower your tax liability while supporting your household, right? And so tax credits can play a big part. That's why in the Clear Edge framework, credits are the first thing that we talk about. Qualified business income. So here's a big one, especially if you run a small business, right? Let me check the chat, see if there's any questions. I'm going through this fairly quickly. But so if you run a small business, own a rental property, or earn income from a pass-through entity, the qualified business income deduction was huge in 2017. Grab a quick sip of water. Um, Why? Because in 2017, the corporate tax rate dropped from 35% to 21%. And lawmakers were like, hey, we don't want to leave pass-through business owners, the S Corp, LLCs, and sole proprietors. That sole proprietors are not pass-through, but they didn't want those folks to be left behind. So they created a brand new deduction to level the playing field, so to speak. So QBI stands for Qualified Business Income, and it's section 199A, and that lets eligible business owners deduct 20% of their income right off the top. So it applies to sole proprietors, partnerships, S corps, rental income via REITs or certain publicly traded partnerships, and agricultural co-ops. But here's the catch: the QBI does not include wages, W-2 wages that you pay to yourself, guaranteed payments to partners, and investment income like dividends or capital gains. So the deduction is tied to your net business income, not payroll or portfolio returns. There are limitations to watch out for. This deduction is not unlimited. There are three key guardrails to this: income phase outs. So in 2025, if your taxable income after all deductions is over 197,300, if you're single, or double that, effectively 394,600 if you're filing joint, your QBI deduction starts to phase out. Okay. There's also some specified service businesses limitations. So if your business is in the field like law, medicine, consulting, accounting, financial services, or performing arts, basically anything tied to your personal skills or reputation, your QBI deduction phases out above those same income limitations or income levels, right? There's a cap based on taxable income. So even if you qualify for the QBI deduction, your deduction can never be more than 20% of your taxable income. And if your QBI dips below zero, you can carry all that loss forward, but you can't carry any unused deduction if you didn't hit the limit. So the bottom line is the QBI is a complex tool that is many tax professionals even struggle to really understand. Um, so here's what the new law does. It makes the QBI deduction permanent, meaning no more sunset date. It increases the deduction to 23% starting in 2026. So it goes from 20% to 23%. And it smooths out the phase out rules to avoid any income cliffs near the threshold. So gives some phase out expandability. It also expands eligibility to certain business development companies. So why does all this matter? It's a really powerful tool for small business, but only if you qualify and structure your business correctly. So it can reward you for owning your own income, not just earning it. But if you're not careful, you could leave tens of thousands of dollars in taxes on the table, right? So the QBI is a tricky, and there's going to be more detailed trainings. This is all brand new legislation, and there's kind of an adoption period where we have to figure out, okay, what does the law say, and then how do we apply it, and what does the IRS want to see in complying to the law? That's why tax filing is called compliance, right? It's that whole compliance piece of it. So, moving on to accelerated depreciation. So, when Congress passed the Tax Cuts and Job Act in 2017, one of the most powerful incentives they included was a major overhaul of depreciation. All that was designed to encourage business investment. So, what changed? Boy, I am struggling today. Let me get some caffeine. Taxes, make sure everybody's still with me in the chat and questions. I must be putting myself to sleep. All right. So what changed? 100% bonus depreciation. Businesses could deduct the entire cost of eligible assets like machinery, vehicles, equipment in the year they were placed in service. This applied to both new and used property as long as it was new to you, right? You purchased something used, but it was new to you. Covered purchases made between September 27th of 2017 and December 31st of 2022. Starting in 2023, that bonus began to phase down 20% each year, dropping to completely zero in 2027. Well, Section 179 was expanded, so that was another way to write off equipment faster. It was boosted to a million. The ceiling for deduction of 179, with the phase out beginning at 2.5 million. Plus, the definition of eligible property for 179 that was eligible for 179 deduction expanded to include things like roofs, HVAC systems, fire and security systems in non-residential buildings. Other things that changed was residential real estate. Well, the depreciation period for residential rental property was shortened from 40 years for buildings placed in service after 2017, making long-term rental real estate more appealing. I think that's a typo, 40 to 30 years. Because residential real property, commercial real property is 39 years, and so they shortened it to 30. auto write-offs, so automobile, the 2017 Tax Cuts and Job Act increased the depreciation limits for passenger vehicles, allowing for faster write-offs of business cars, right? Um, and then there was something called the qualified improvement property. So this is a huge hiccup here because QIP, qualified improvement property, is meant to get a faster 15-year write-off schedule, but Congress really kind of goofed on the drafting of that. That got fixed in the CARES Act of 2020. There was a few years where there was some uh, confusion around what qualified improvement property was. So fast forward to today, the big beautiful bill, or OB3, right? The OB3 restored the bonus depreciation for property, but placed in service after January 19th, 2025. So if you bought something January 1st through the 19th, sorry, you're limited to the bonus depreciation, which I think is down to 40% for 2025. But after January 19th, you get to write off the 100%, right? Why they chose 2019 or January 19th, who knows what Congress critters are smoking when they do all of this. So, but that's the date that they chose. The OB3 also expands to 179 again, raising the limit to 2.5 million, with the phase out starting at 4 million. So that allows way more ability to expense and fully deduct equipment and machinery and qualified assets. So more upfront write-off, again, faster ROI, reducing your tax bill now. It also gives 100% expensing for manufacturing facilities, and this applies to projects starting after January 19th, 2025 and before January 1st, 2029. So there's incentive there to invest in domestic production, right? They're saying, hey, you've got a timeline where if you're going to build manufacturing facilities, get after it. We want manufacturing in the United States. There's also some changes to flexibility on R&D. Businesses can now deduct 100% of domestic research and development costs that they incur in the year that they incurred them, or they can choose to amortize them based on the useful life of the research. So that's huge. These changes are more than just policy shift. They're actually strategic tax tools that are really designed to help incentivize investing in U.S. business, right? Without the wait. So they're saying, hey, you can deduct it now. You can deduct it now. So manufacturers, real estate investors, contractors, consultants, if you're buying assets or upgrading your workspace, this is Congress saying, hey, here's your green light to go big, go smart, and go now. They want you to buy and incentivize the economy. So that's kind of the idea behind those provisions. One of the most controversial changes from the 2017 tax law was the 2017 SALT cap, right? State and local deduction. So before Tax Cuts and Job Act, you could deduct all of your state local income tax, property tax, but then it changed in 2017 that got capped at 10 grand, no matter how high your state income taxes were, right? I just was up in our state income tax and property tax up in Lake Tahoe over the 4th of July kind of weekend, and hot dog, I was looking up at property prices, and it's like, wow, those people are paying like 30, 40, 50 grand a year just in their property taxes. Ooh, that's a killer. So states with high tax like California, New York, even Texas with high property taxes, right? They don't have an income tax, but they have high property tax. Some of those got hit by that cap where it's like, oh, you can only deduct 10,000. So there was a really huge political firestorm over that. Democrats, especially from the high tax blue states, they pushed hard to lift or eliminate the cap. They were like, "Hey, it pushes middle and upper middle class income families in their districts and into that. It punished them with higher tax rates, and then discourage economic growth by double taxing income." Republicans, they wanted to keep the cap because they saw a way to stop the federal government from subsidizing high state tax policies. And then they're like, hey, this gives fiscal discipline at the state level. If you're going to tax those people at those amounts, you need to keep that money. So it was a real political firestorm, kind of followed that throughout the process. Um, but at the end of the day, there's been a lot of people that have fought against the cap to get that back. The numbers are also problematic because capping the SALT deduction is how Congress helped to pay for other tax cuts. So they're like, hey, we're going to limit this deduction here to 10 grand, and that's going to give us revenue to pay for other things that we're doing. So uh, fully repealing, according to the Congress or the Congressional Budget Office, said we're fully repealing the salt cap back to pre-2017 would add about 1.2 trillion to the deficit. So all of this in context for it's time to compromise. So the compromise for the big beautiful bill or OB3 was the new law doesn't fully repeal the salt cap, but it just raised it pretty significantly. So it increased the salt cap from 10,000 to 40,000. So 2025 through 2029, regardless of filing status, and begins a phase out for incomes above $500,000. Both the cap and the income threshold then increase 1% per year through 2029. But in 2030, it all goes back to the $10,000 cap. So there's a sunset on this. There's provisions to say, hey, it's going to increase, but then it's going to rewind and revert back to the $10,000 cap. So if you're in a high state income tax bracket, you've got a 5-year window to benefit from this. And it's not a political issue, giving you political context, it's a planning issue. So if you live in that high tax state and own a business or rental property, your personal tax bill is likely affected by this cap. It makes it even more important to look at strategies like maximizing other deductions, using accountable plans, shifting income tax to lower tax entities or family members legitimately, or consider relocating or restructuring long term, right? The PTE, the pass-through tax entity deduction, where you pay your state income tax through your business, your corporation, that workaround is still on the table as of yet. We haven't seen that is going away, but so that's still a valid strategy at this time, subject to change because as we get into the weeds of the law and how it affects or how it's applied, that's where we could get some clarification and guidance from the IRS. The estate tax, that is a topic. It doesn't apply to most Americans, but if it applies, then it really matters. So let's hit it quickly. The federal estate tax limit. So you'll never pay this tax yourself because it kicks in after you're gone. It's your estate. But your kids, grandkids, or whoever inherits your wealth will absolutely care if you plan wisely. So, how the estate tax works is this. There's a unified US tax code includes what's called a unified credit. It's the amount you can pass along during your lifetime or at death without paying federal estate gift tax. For 2025, the exclusion is $13,999. So almost per person. So almost 14 million and almost 28 million for married couples. So if your state's under those limits, mine is, I don't know about you, but you're in the clear. So if it's over that, then the IRS takes 40% of everything above that line, due within 9 months of death. So the state tax hits very few people. Fewer than 10,000 estate tax returns are filed each year, and even fewer owe tax. But the revenue it brings in, about 25 billion, is actually a drop in the bucket compared to the federal budget. That doesn't mean it's not important. For high net worth families, this can wipe out millions of dollars if you don't plan accordingly. So what OB3 changed was without action, the at the end of 2025, the estate tax exemption was going to drop in half, basically to about 7 million per person starting in 2026. But the new bill changed that. It bumped it up to a flat 15 million per person. That means 30 million per couple. It also indexed that amount to inflation so it keeps pace with the rising asset values. So it's a huge opportunity to protect long-term wealth while the rules are favorable. So what this means for you, if your state's estate is anywhere near or above that threshold, or if you're building a business or real estate portfolio that will put you there eventually, it's time to get really proactive and look at gifting strategies, irrevocable trust, family partnerships, valuation discounts, different things that can help you protect what you've worked hard for to ensure your wealth gets passed on tax efficiently and on your terms, right? Let's hit the green energy. So under the 2022 Inflation Reduction Act, the Biden administration made clean energy tax incentives really a core part of the climate and economic strategy. The idea was to lower household energy costs, jumpstart domestic clean energy jobs, accelerate the shift to electric vehicles, renewables, and low carbon manufacturing. Well, in total, the Inflation Reduction Act, or IRA, created or expanded over 20 tax credits for individuals and businesses, including a $7,500 credit for new electric vehicles, 4,000 credit for used electric vehicles, 30% residential solar credit, large investment in production credits for commercial wind and solar projects, and extra incentives for projects to build low income or fossil fuel reliant communities. So, what changed in 2025? Well, when Republicans took back control in 2025, they came back with a different focus. They're scaling back some of the green energy incentives and reallocating those tax dollars elsewhere. That's where the OB3 comes in. The bill eliminates or phases out electric vehicle credits that ending after September 30th, 2025. So that if you buy an electric vehicle after September 30th, 2025, no credit. So if you're thinking about this, it might be the time to do that. So that includes the $7,500 credit for new electric vehicles and the 4,000 credit for used electric vehicles. And yes, that's rumor has it Elon Musk was not thrilled about that. So I'll leave that where it stands. The residential solar credits are also ending after 2025. 30% credit for home solar installations is going away. So if you're planning a system, 2025 may be your last shot to fully claim the benefit. Commercial wind and solar credits are also getting phased out. These credits will expire for projects not placed in service by December 31st, 2027. All this being said, what this means for you is if you're a homeowner considering solar or looking at electric vehicle, the clock is ticking. 2025 is your window to really lock in those things, and before September 30th for the electric vehicle. If you're in construction, manufacturing, development, these changes might reshape how you approach energy efficiency investments and projects going forward, right? So again, we're not here to play politics. We're just here to help you understand, hey, here's what changed, and here's how to use these changes to your advantage ethically and effectively, right? So helping knowledge is power, and helping to understand the big picture landscape is important. But wait, there's more. So we've talked, Trump and every other Republican running in 2024 campaigned hard on one thing, on the tax promise above all. They were, hey, we're going to extend the 2017 Tax Cuts and Job Act. That was the cornerstone. But along the way, a few attention grabbing proposals were thrown out on the campaign trail. Some of them stuck, some of them didn't. So let's unpack in the OB3 what did stick. So no tax on tips, kind of. So the idea, Trump says, came from a dinner in Las Vegas when his server complained about being taxed on her tips. That's the next thing you know, it's a campaign promise. So Democrats like Kamala Harris also picked it up. So there was more than one party kind of pitching this, saying, hey, this should be a thing. So starting in 2025, servers can exclude up to $25,000 on tip income from income tax, not payroll tax. So they still have to pay Social Security and Medicare, the payroll taxes. This runs through 2028. And if you make over 150 grand if you're single, the benefit phases out. Married, filing joint if you're over 130 grand. So why does that matter? Well, workers in service industries, that's great news, but it also raises fairness questions. So why exclude servers but not hostesses? What about hairstylists and rideshare drivers? So the law is targeted towards the service industry, the um, food service, right? Servers. Um, no tax on overtime, right? So again, sort of. This one also made the headlines, and the logic was simple. Why penalize people for working extra hours? So from 2025 through 2028, eligible hourly workers can exclude overtime from income tax. Again, not from payroll tax. The exclusion is capped at 12,500 for singles and 25,000 for joint filers. Again, when you start to make over 150 grand as a single person or over 300,000 as a married filing joint, there it's going to be uh, threshold and phase out. So you lose the ability. All of a sudden, it can start to become taxable. The catch is the definition of overtime can get tricky, especially for salaried employees or exempt employees, workers. So this is targeted towards hourly folks. And there's going to be some guidance. We're going to need some information from the IRS to clarify, because all of a sudden magically, like, hey, I work for tips or I'm working overtime, right? So we need some guidance from the IRS on the applicability of this. But those are the rules, or that's the information we have so far. No tax on Social Security. Well, kind of, not quite. The idea was floated on the idea of eliminating tax on Social Security benefits altogether. But here's the beef. IRS collects over $50 billion per year from taxing benefits, and Social Security is already strained. So they need the money to fund Social Security, ironically enough. So the full idea didn't get the cut. But here's what happened. So seniors age 65 or older get a $6,000 boost to their standard deduction from 25 to 2028, right? So you get an automatic, hey, we're going to give you another $6,000 tax free, which helps reduce your taxes. It does phase out. So if you make over $75,000, if you're single, or over 150 grand for adjusted gross income for couples, you start to lose that $6,000 additional standard deduction. So it does give relief to retirees, but doesn't fully eliminate the benefit of tax benefit itself. The new deduction for car loan interest. Well, new car, I don't know if you've tried to buy a car recently, but new car prices are climbing fast, right? To on average over $48,000. So this one was kind of a crowd pleaser as well. The bill introduced a new above the line deduction, meaning you don't have to itemize to take this deduction. It can be, if you itemize or don't itemize, you can still take this. You can deduct up to $10,000 of interest per year, but it only applies to new vehicles, not new to you, not used, but brand new vehicles assembled in the US, and only for loans that you have taken between 2025 and 2028. So if you had a loan that you bought a new vehicle last year, sorry, that doesn't apply to you. You can't deduct that interest. Again, this is for personal. If you have a vehicle that you've purchased for business, you can deduct in certain circumstances. You can deduct the interest on the car loan. Um, if you're using actual expenses for the car. So this is for personal use vehicles only. There are phase outs, 100,000 if you're single, 200,000 if you're married filing joint. And if you start to make over those amounts, then you lose the ability to deduct that. So if you're in the market for a new vehicle already, timing your purchase for 2025, because 2025 through 2028, but you can only deduct the interest on those loans. So if you're buying 2028, you can only deduct that interest for 1 year until this expires, unless Congress says, hey, we're going to do this differently, and they're going to update the laws. So these aren't fully just headline grabbers. They are and they aren't, but they can be opportunities to fine tune your personal strategy. So restaurant owners and managers managing tip reporting, that's important. Hourly worker clocking overtime, right? If you're working hourly, retiree on a fixed income, pay attention to these things, or a family if you're buying a brand new car, right? So these are some things that could impact your taxes. Surprise, here's a couple more things that, like any bill, You can bet that lawmakers are going to sneak in some pet provisions or what's called pork sometimes. On Capitol Hill, they apparently are calling it hanging ornaments on the Christmas tree. So some ideas got stripped out along the way. Let's like a push to let the federal government sell off land for housing, and the House it passed a ban on states regulating AI, right? So there are some things that were things that were hot button issues that didn't want to have happen and some wanted to have happen, but a handful of last minute provisions did sneak into the bill, and they could actually mean some real opportunities for smart taxpayers. So let's walk through some of the wild cards of the OB3, or the big beautiful bill. Um, the win for startup investors, right? It extends the expanded the qualified stock, uh, qualified small business stock. Now, if you're a founder, startup, or angel investor, or early stage equity holder, this could be huge. Qualified small business stock lets you sell eligible shares in a startup, and you can exclude the gain when you sell those shares from your income. So under the old law, you could exclude up to 10 million or 10 times your basis, whichever was greater. So if you bought it for a million and or 2 million and it increased to 20 million, 10 times your basis would be that 2x, right? That would be what you could exclude. Now for stock acquired after July 4th, 2025, that gross asset limit jumps to 50 million, from 50 million to 75 million. The gain exclusion rises to 15 million in index for inflation. So you can now exclude 50% of your gain after 3 years, exclude 75% of your gain after 4 years, and still exclude 100% after the 5 years within those limitations. So why does that matter? It's huge if you're scaling a business, especially in tech and manufacturing. Timing your investment windows, right, could make sense. You're like, oh, I'm going to inject or raise capital for a business, but if I raise capital after this date, then there's an opportunity to help those investors or help yourself exclude more of that gain. Gamblers, you need to be aware there's a loss deduction that was trimmed. Under the old law, if you won $100,000 at the casino, lost $100,000, you broke even, assuming you itemized. Under the new rule, starting in 2026, you could only deduct 90% of your gambling losses. So if you win 100 grand and lose 100 grand, you still owe tax on $10,000 of phantom income. That's a bad bet if you're a gambler. So just be wary of that gambling losses, you could end up paying taxes on money that you lost. Whale hunting. Yeah, seriously, right? The deduction for whale hunting expenses, related expenses, jumped from 10,000 to 50,000. It applies to the Alaska Eskimo Whaling Commission captains participating in sanctioned hunts. The bill also creates new tax exemptions for fishing income in select Alaskan villages, part of a deal to win Senator Lisa Murkowski's vote. Moral of the story: pork happens. Politicians sneak in and say, hey, if you're going to give me my vote, this is how it's got to benefit. This bill needs to benefit my people. I can't blame them for watching out for their people at home, but I guess even whale hunters need tax planning. So small minority, and I would call out, that does apply to sanctioned hunts, but apparently there is still whale hunting that occurs. Okay. Section 529, college savings accounts. Those got supercharged. So starting in 2026, your withdrawals for K through 12 tuition raised to $20,000 per year. So you can now use 529 plans, college savings plans, for 7 new education expenses, including homeschooling materials, online courses, tutoring, test fees, dual enrollment college fees, special needs education. Why does that matter? Well, parents have more flexibility than ever using 529 plans. Bigger charitable donations, no itemizing required. Now there's an above the line category where there never has been, to my knowledge, for charitable giving. So you can, if you give $1,000 or 2,000 for single or married filing joint, you do not need to itemize to claim that. So That's great for anybody using the standard deduction, those higher standard deductions that still wants to give back. The adoption credit is now fully refundable, up to $5,000. So if you're adopting, that can matter. And we're gonna skip the Trump accounts for newborns. There's some clarification that needs to happen around those, but just be aware that there are new provisions for Trump accounts for newborns where you can contribute money every year, and the funds can be invested, and then effectively it's kind of like a Roth in the sense that you can invest for the future. Um, Other wild cards, corporate tax rates are still on the table. So corporate tax rate was permanent and nothing was changed. There's proposals around dropping the corporate tax rate from 21% down to 20 or even down to 15%. Um, who knows what will happen? Tariffs, the hidden tax. President Trump once called tariffs the most beautiful word in the English language. He's not shy about using them, but here's the math. The U.S. imports $3.2 trillion in goods and services each year. A 10% tariff could raise up to $300 billion a year in theory. But on the back end, tariffs long term often backfire, leading to retaliation, price hikes, and economic drag. So, in short, tariffs, I personally believe that the tariff conversation is a negotiation tactic to say, hey, we're going to do this, meant to be, I think, a short-term revenue bump, but not a reliable replacement for tax policy. It's really designed, I think, to get people to the table to have conversations. And as usual, the usual DC shenanigans, Congress's favorite pastime is changing the rules. Let's be real. Um, Mark Twain once said, "No man's life, liberty, or property are safe when there's the legislature is in session." So, if Martians showed up today demanding tax breaks, would anybody really be shocked? Not really. Anything could happen. So the big beautiful bill is the point is that the big beautiful bill extends 2017 tax cuts, just like Trump and Congress promised when they were running. But tax policy is always subject to politics, pressure, and pivoting priorities. So don't just react to tax law, plan for it, build and plan for the now and be smart about your money and where you spend for the future. Any questions at this point juncture? I haven't seen any in the Q&A. We've covered a lot of ground today. Rates, cuts, deductions, credits, expansions, eliminations, and even those, pork, the hanging ornaments on the Christmas tree, curveball. So, what I want to hear from you is, do you think the big beautiful bill will fuel economic growth, or are you concerned that more growing deficits might force Congress to scale things back again? I'm kind of in the camp of, less taxes gives business owners the ability to do more with their money. But the spending and making sure reining in spending is also important. Any questions that you have for me at this point? I don't really see anything in the chat. So it is, we're coming up on time, and I'm going to let you guys go, and I'm going to stop sharing my screen. Thank you for attending. If you attended live, thanks for coming today. If you're watching the replay, share this with a friend if you found this to be valuable. This is very broad strokes introduction of, hey, here's some things that changed. This is what happened. Where do we think we're heading as we get more information and more clarity? We will be releasing additional things, but this was a very timely topic for our monthly open office hour that we host the second Wednesday of every month at 10 a.m. Pacific. So thanks for being here. And if you can't be good, be careful. Next time we'll see you. Thanks. Bye for now.